Tonight, we explore the hidden engine behind what recessions reveal about the financial system, operating unseen yet powerfully. There are moments when the ordinary rhythm of economic life changes, when the patterns that seemed stable begin to shift, when the mechanisms that operated quietly in the background suddenly become visible. These moments are called recessions. They represent periods when economic activity contracts, when growth reverses, when the normal flow of commerce and production slows down. Most people experience recessions as disruption. Jobs become harder to find. Businesses struggle or close. Incomes decline or grow more slowly. The sense of forward progress gives way to uncertainty and constraint. But beneath this surface experience, something deeper is happening. Recessions are not merely unfortunate events. They are revealing moments. They are times when the underlying architecture of the financial system becomes visible in ways it normally is not. During periods of expansion and growth, many features of the financial system remain hidden. They operate smoothly. They function without drawing attention. The connections between different parts of the system work quietly. The vulnerabilities remain concealed. When a recession arrives, these hidden features emerge. The connections become strained. The vulnerabilities become apparent. What was obscured by prosperity becomes clear through adversity. This revelation is not intentional. No one designs recessions to expose the workings of the financial system. Yet this exposure happens nonetheless. It happens because recessions test the system in ways that normal times do not. The test is comprehensive. It touches every component of the economy. It affects banks and businesses. It affects workers and consumers. It affects governments and markets. It affects the flow of money, credit, and confidence. Through this comprehensive testing, certain truths become visible. Truths about how the financial system is structured. Truths about where strength lies and where weakness exists. Truths about what holds the system together and what can pull it apart. These truths exist during good times as well, but they remain in the background. They are theoretical rather than immediate. They are possibilities rather than realities. Recessions make them real. They transform theoretical vulnerabilities into actual problems. They turn hidden connections into visible dependencies. They reveal the difference between what appears solid and what actually is solid. Understanding what recessions reveal requires looking beyond the immediate hardship they create, beyond the job losses and business failures, beyond the declining statistics and negative headlines. It requires examining what these periods of contraction expose about normal times, about how the system operates when things are going well, about what that operation depends upon, about what assumptions it rests on. The financial system, in its normal state, appears robust. Money flows smoothly through banks and markets. Credit is readily available. Transactions happen seamlessly. Confidence prevails. But this appearance conceals complexity. It conceals interdependencies that are invisible until they matter. It conceals fragilities that are irrelevant until they are not. Recessions strip away this concealment. They reveal the interdependencies by breaking some of them. They expose the fragilities by stressing them to the point of failure. What emerges from this revelation is insight. Insight into how the financial system truly works. Not how it appears to work during prosperous times, but how it actually functions under pressure. This insight is valuable. It is valuable for understanding the system's architecture, for recognizing its limitations, for appreciating its resilience where it exists, for identifying where improvements might be made. But the insight comes at a cost. The cost of the recession itself. The cost of the disruption and hardship. The cost measured in lost jobs, closed businesses, and diminished prosperity. Still, the revelation happens whether anyone seeks it or not. Recessions disclose what normal times conceal. They make visible what is usually invisible. They demonstrate what is usually assumed. The demonstration is not gentle. It is not academic. It is lived experience for millions of people. It is real consequences in real time. Yet through this difficult experience, certain patterns become clear. Certain relationships become obvious. Certain mechanisms become undeniable. These patterns, relationships, and mechanisms are always present. They operate continuously. But they operate quietly during normal times. They become loud only when tested. A recession is such a test. It is a stress test for the entire financial system. It reveals what can withstand pressure and what cannot. It shows what is essential and what is peripheral. It demonstrates what connects to what and how those connections matter. The test is not standardized. Each recession is different. Each arises from different circumstances. Each stresses the system in different ways. But all recessions share certain characteristics. All involve contraction rather than expansion. All involve decline rather than growth. All involve the reversal of processes that normally move forward. This reversal is what creates the revelation. When processes reverse, their mechanics become visible. When growth turns to contraction, the factors that enable growth become apparent through their absence. The absence reveals what was present. The breaking reveals what was connecting. The failure reveals what was sustaining. Through this revelation, understanding deepens. Not just understanding of recessions themselves, but understanding of the system that recessions disturb. Understanding of how that system operates normally. Understanding of what it depends upon to function. This understanding is the subject of what follows. An exploration of what recessions expose. An examination of what becomes visible when the financial system faces stress. The exploration moves calmly. There is no urgency here. There is only the steady unveiling of insights that emerge when economic contraction reveals what economic expansion conceals. A recession, at its most basic, is a period of declining economic activity. The decline is broad. It affects multiple sectors and regions. It persists for more than a brief moment. It represents a sustained reversal of growth. This reversal manifests in measurable ways. Production decreases. Employment falls. Income declines. Spending contracts. Investment slows. These are the symptoms of recession. They are what people experience and what statistics capture. But the recession itself is something deeper. It is a shift in the underlying dynamics of the economy. During normal times, the economy expands. More goods are produced. More services are delivered. More people work. More income flows. More transactions occur. This expansion is self-reinforcing. Production creates income. Income enables spending. Spending generates demand. Demand justifies more production. The cycle continues as long as confidence and resources sustain it. As long as businesses believe they can sell what they produce. As long as consumers believe their incomes will continue. As long as credit remains available to bridge timing gaps. But this cycle is not automatic. It is not guaranteed to continue indefinitely. It depends on conditions that can change. When those conditions deteriorate sufficiently, the cycle reverses. Expansion gives way to contraction. Growth turns to decline. Recession begins. The reversal can start from various points. Sometimes it begins with reduced demand. Consumers spend less, perhaps due to rising debt or falling confidence. Reduced spending means businesses sell less. Selling less, they produce less and employ fewer workers. Fewer workers means less income, which means even less spending. Sometimes the reversal begins with tightened credit. Banks become more cautious about lending. Credit becomes harder to obtain. Without credit, businesses cannot invest or expand. Consumers cannot make major purchases. Economic activity slows. Sometimes it begins with external shocks. A sudden increase in commodity prices. A financial crisis in another country. A disruption to critical supply chains. These shocks create costs or constraints that ripple through the economy. Whatever the starting point, the result is similar. The reinforcing cycle that drives expansion begins working in reverse. Contraction feeds on itself just as growth once did. This self-reinforcing contraction is what makes recessions more than temporary pauses. They are not simply moments of flat activity. They are periods of active decline. Decline that continues until something interrupts the downward spiral. What recessions reveal about the financial system begins here. With this understanding that the system is cyclical, that it does not move smoothly in one direction. That expansion contains the seeds of eventual contraction. The financial system is designed to support economic activity, to channel savings into investment, to provide liquidity for transactions, to enable promises made today to be fulfilled tomorrow. During expansions, it performs these functions well. Money flows where it is needed. Credit bridges gaps between earning and spending. Markets facilitate exchange and price discovery. But the system is also procyclical. It amplifies whatever direction the economy is moving. When times are good, it makes them better. Credit flows freely, supporting more activity. Asset prices rise, creating wealth effects. Confidence builds on itself. When times turn bad, the system amplifies that direction too. Credit contracts, starving activity of fuel. Asset prices fall, destroying wealth. Confidence collapses, creating self-fulfilling pessimism. This procyclical nature is one of the first things recessions reveal. The financial system does not stabilize the economy. It magnifies whatever forces are already in motion. Recessions also reveal the importance of expectations. The financial system operates largely on promises about the future. Loans are promises to repay. Investments are bets on future returns. Employment is an exchange of labor for future compensation. When recession threatens, these future-oriented arrangements become problematic. Uncertainty about the future makes promises less reliable. It makes investments riskier. It makes commitments harder to sustain. The shift in expectations can happen quickly. What seemed certain yesterday becomes doubtful today. What seemed sustainable becomes precarious. This shift reveals how much the financial system depends on confidence, on shared belief that tomorrow will be reasonably similar to today, on trust that counterparties will fulfill their obligations, on faith that the system itself will continue functioning. When confidence erodes, the mechanics of the system are exposed. It becomes clear how much depends on intangible factors, how much rests on psychology rather than physical reality. Money itself is largely a matter of confidence. Currency has value because people believe it has value. Bank deposits represent promises that can be redeemed. These promises hold only as long as confidence in banks remains intact. During normal times, this fragility is invisible. Everyone accepts money and honors promises. The system works smoothly because everyone expects it to work. During recessions, the fragility becomes apparent. Bank runs can occur when confidence falters. Credit markets can freeze when trust evaporates. The system's dependence on collective belief becomes undeniable. Another revelation concerns leverage. The financial system enables borrowing. It allows individuals, businesses, and governments to spend beyond their current resources by promising future repayment. Leverage amplifies both gains and losses. During expansions, borrowed money enables more activity than would otherwise be possible. It accelerates growth. It creates prosperity faster than saving alone would permit. During recessions, leverage becomes a burden. Debts accumulated during good times must be serviced during bad times. Income may decline, but debt obligations remain fixed. This mismatch creates stress. The stress can force cutbacks in other spending. It can lead to defaults when obligations cannot be met. It can cascade through the system as defaults affect creditors who then face their own difficulties. Recessions reveal how much of the apparent prosperity during expansions was built on borrowed foundations. How much depended on the assumption that growth would continue. How vulnerable the system becomes when that assumption proves false. They also reveal the interconnectedness of the financial system. During normal times, the connections between institutions are invisible. Banks lend to each other. Financial institutions hold each other's assets. Companies do business with each other. Workers depend on their employers, who depend on their customers. These connections create networks. Networks that function smoothly when conditions are good. But networks that transmit stress when conditions deteriorate. A problem at one institution can spread to others. A failure in one sector can affect seemingly unrelated sectors. The interconnections that enable efficiency during normal times become channels for contagion during crises. Recessions reveal the existence and importance of these hidden networks. They show how failure can cascade, how local problems can become systemic, how the financial system is less modular and more integrated than it appears. What emerges from these revelations is a picture of the financial system as complex and fragile. Complex because of the countless connections between its components. Fragile because so much depends on confidence, expectations, and the continuation of specific conditions. Yet the system is also resilient in certain ways. Recessions end. The economy eventually recovers. The financial system, though stressed, typically survives. This resilience comes from multiple sources. From policy interventions that support the system during stress. From the diversification of risks across many actors. From the fundamental human capacity to adapt and rebuild. But the resilience is not automatic. It requires active management. It requires institutions that can respond to crisis. It requires mechanisms that can absorb shocks without complete collapse. Recessions reveal both the fragility that requires such mechanisms and the resilience that emerges when they function properly. They show the system at its most vulnerable and, eventually, at its capacity to recover. Understanding what recessions reveal, thus, means understanding both aspects. The vulnerabilities that stress exposes and the strengths that enable survival. The weaknesses that allow crisis and the capabilities that enable resolution. This dual nature of the financial system becomes visible only during recessions. Normal times show primarily the strengths. Only stress reveals the weaknesses. Only crisis tests the capacity to respond. The revelation is neither completely pessimistic nor completely optimistic. It is simply realistic. It shows the system as it actually is: capable but vulnerable, functional but fragile, resilient but requiring care to maintain that resilience. This realistic understanding is what recessions provide, not through deliberate instruction, but through lived experience. Not through theory, but through demonstration. The demonstration is costly, but the understanding it provides is genuine. It is understanding based on evidence rather than assumption, on observation rather than speculation. What follows is an exploration of how this understanding develops, how recessions form and unfold, how they stress the system and reveal its working, how they eventually resolve, and what that resolution shows. The exploration continues calmly, without drama or urgency, simply following the patterns that emerge when economic contraction exposes what economic expansion conceals. Recessions do not appear suddenly from nowhere. They form gradually through the accumulation of imbalances and stresses. They emerge when certain conditions reach critical thresholds. The formation process often begins during the expansion that precedes the recession. During periods of growth, certain behaviors become common. Borrowing increases as confidence rises. Investments are made based on optimistic assumptions. Risks are taken that would seem imprudent during less prosperous times. This behavior is rational at the individual level. When the economy is growing, taking on debt makes sense. Future income is expected to be higher, making repayment easier. When asset prices are rising, investment seems profitable. When businesses are expanding, hiring and capital investment appear justified. But what is rational individually can become problematic collectively. As more borrowers take on debt, the total level of leverage in the system rises. As more investors chase returns, asset prices may exceed underlying values. As more businesses expand capacity, total supply may eventually exceed demand. These accumulating imbalances create vulnerability. They create conditions where small disruptions can trigger larger problems. They create instability masked by the appearance of prosperity. The formation of recession often involves the building of these vulnerabilities over time. Over months or years during which growth continues, but imbalances accumulate. At some point, something changes. The change might be a shift in policy. Central banks might raise interest rates to prevent overheating or control inflation. Higher rates make borrowing more expensive. They slow credit growth. They can pop asset bubbles that depended on cheap financing. The change might be external. A commodity price shock that raises costs throughout the economy. A financial crisis elsewhere that affects confidence globally. A geopolitical event that disrupts trade or investment. The change might be internal to the economy itself. Consumers might reach debt levels where they must cut spending to service obligations. Businesses might complete investment projects that expand capacity beyond what demand can absorb. Asset prices might reach levels that can no longer be justified by fundamentals. Whatever triggers the shift, the effect is to expose the vulnerabilities that accumulated during the expansion. The comfortable assumptions about the future become questionable. The risks that were ignored become relevant. The imbalances that were building become unsustainable. As confidence shifts, behavior changes. Lenders become more cautious. They tighten credit standards. They demand higher interest rates to compensate for perceived risks. They reduce their willingness to lend. Borrowers face difficulty obtaining or refinancing loans. Businesses that depended on credit to operate face constraints. Consumers who relied on credit for major purchases must cut back. The easy flow of credit that characterized the expansion slows to a trickle. This credit contraction affects spending and investment throughout the economy. Less credit means less purchasing power. Less purchasing power means less demand. Less demand means businesses sell less. Selling less, they cut production and employment. As employment falls, income falls. Falling income further reduces spending. Reduced spending further cuts into business revenue. The self-reinforcing downward cycle begins. Asset prices also adjust during this formation process. Stock prices fall as expectations for corporate profits decline. Real estate prices soften as fewer buyers can obtain mortgages. The wealth effects that supported spending during the expansion reverse. Falling asset prices create additional stress. They reduce collateral values, making it harder to borrow against assets. They create losses for investors, reducing their capacity to spend or invest. They can trigger margin calls and forced selling that accelerate the decline. The formation of recession thus involves multiple reinforcing mechanisms. Credit contraction, falling asset prices, rising unemployment, declining confidence, reduced spending. Each mechanism amplifies the others. Each makes the overall situation worse. The system that amplified growth during expansion now amplifies contraction. The formation reveals several aspects of the financial system. First, it reveals the system's procyclical nature. The mechanisms that support growth during good times intensify decline during bad times. Banks that were eager to lend during expansion become reluctant during contraction. This reluctance, though rational for individual banks protecting themselves, worsens the overall situation. It deprives the economy of credit precisely when credit is most needed to maintain activity. Similarly, investors who bid up asset prices during optimism drive them down during pessimism. The herd behavior that creates bubbles also creates crashes. The financial system's tendency to follow momentum rather than counter it becomes starkly visible. Second, the formation reveals the role of leverage in creating fragility. The debt accumulated during expansion must be serviced during contraction. This creates a drag on spending and investment that would not exist if growth had been financed entirely through retained earnings and savings. High leverage means that even small declines in income or asset values can create insolvency. It means that more entities are vulnerable to failure. It means that the margin for error is smaller. The system's encouragement of leverage through low interest rates and easy credit during expansions plants the seeds of eventual recession. The very success in promoting growth creates the conditions for future contraction. Third, the formation reveals the importance of expectations and confidence. The shift from expansion to recession often begins in psychology before it appears in statistics. Changing expectations alter behavior in ways that make the expected outcomes more likely. If businesses expect recession, they postpone investment and hiring. If consumers expect unemployment, they increase savings and reduce spending. If lenders expect defaults, they restrict credit. These defensive actions, though rational individually, collectively create the recession that was anticipated. The financial system's dependence on forward-looking expectations makes it vulnerable to self-fulfilling prophecies. What people believe about the future shapes present behavior in ways that help create that future. Fourth, the formation reveals the interconnectedness of the system. Problems in one sector spread to others. Weakness in housing affects construction, finance, and retail. Stress in banking affects all sectors that depend on credit. International linkages transmit recessions across borders. The complex web of relationships that enables the efficient functioning of the financial system becomes a transmission mechanism for crisis. The same connections that allow resources to flow to their most productive uses also allow problems to cascade throughout the economy. The formation process is thus not simply a matter of reduced economic activity. It is a systemic shift in how the financial system operates. From supporting expansion to intensifying contraction. From confidence to caution. From risk-taking to risk avoidance. This shift does not happen uniformly. Different parts of the system may move at different speeds. Some sectors may enter recession while others still grow. Some regions may suffer while others remain relatively healthy. But the overall direction becomes clear as the formation progresses. The accumulating stresses, the changing behaviors, and the reinforcing feedback loops all point toward contraction. Toward recession. Understanding how recessions form provides insight into the financial system's normal operation. It shows how behaviors that seem prudent individually can create systemic problems. It shows how the system's procyclical nature can amplify both growth and decline. It shows how leverage and expectations and interconnections shape outcomes. These features exist during normal times, but they are most visible during the formation of recession. When the mechanisms reverse direction and the assumptions of prosperity give way to the realities of contraction. The formation is gradual in most cases. The stresses build over time. The shift in behavior happens incrementally. The feedback loops take time to gain strength. This gradualness means that recessions are often recognized only after they have begun. The early signs may be ambiguous. The shift from expansion to contraction may not be obvious until it is well underway. By the time recession is widely acknowledged, the formation process is complete. The self-reinforcing contraction has taken hold. The challenge then becomes not preventing the recession, but managing its depth and duration. This lag in recognition reveals another aspect of the financial system. Its complexity makes real-time assessment difficult. The data that would definitively indicate recession are available only with significant delays. The judgment about when a recession began is often made months after the fact. The system operates with imperfect information about its own state. Decisions are made based on incomplete understanding of current conditions. This information lag affects both private actors and policymakers. It means responses to emerging recessions are often delayed until the contraction is already significant. The formation of recession thus reveals not only the vulnerabilities of the financial system, but also the limits of visibility into its current state. The system is complex enough that understanding what is happening requires time and data that may not be available when decisions must be made. This complexity is a fundamental feature of modern financial systems. It results from the vast number of actors, transactions, and relationships that comprise the economy. It cannot be eliminated without simplifying the system to a degree that would sacrifice its efficiency and productivity. But the complexity creates challenges during transitions. During shifts from expansion to contraction or from stability to stress. During these transitions, the system's opacity makes navigation difficult, makes policy response uncertain, makes collective coordination challenging. Recessions reveal this challenge. They show how difficult it is to see clearly when the system is changing state. How hard it is to know whether current difficulties are temporary or the beginning of sustained contraction. The formation process, once visible in hindsight, shows patterns that seem obvious. The accumulation of imbalances, the shift in sentiment, the onset of self-reinforcing decline. But in real time, these patterns are obscured by noise and ambiguity. This gap between clarity in hindsight and uncertainty in real time is another revelation about the financial system, about its inherent unpredictability despite its apparent structure, about the limits of foresight despite the availability of data. The formation of recession emerges from the system's own dynamics, from the behaviors it encourages during expansion, from the vulnerabilities those behaviors create, from the shifts in confidence and expectations that eventually occur. Understanding this formation process means understanding the financial system as inherently cyclical, as containing within itself the seeds of both expansion and contraction, as naturally unstable despite its appearance of solidity during calm periods. This instability is not a flaw to be fixed. It is a feature of a system built on credit, leverage, expectations, and interconnection. These elements enable the system's productive capacity. They also create its vulnerability to recession. The formation reveals this dual nature. The same mechanisms that drive prosperity also enable crisis. The same features that make growth possible also make contraction inevitable. This is perhaps the deepest revelation of the formation process, that the financial system is not a machine that can simply be set to produce steady growth. That it is a complex, adaptive system whose dynamics naturally include both expansion and contraction. Accepting this reality means accepting that recessions will occur, that they emerge from the system's normal functioning rather than from avoidable mistakes alone, that preventing them entirely would require changing the fundamental nature of the system itself. What can be influenced is the severity and duration of recessions, how deep the contraction becomes, how long it persists, how much damage it causes. But the cyclical nature itself appears inherent, a fundamental characteristic revealed by the repeated formation of recessions throughout economic history. Understanding this helps put recessions in context. They are not aberrations. They are expressions of the financial system's underlying dynamics. They are periods when those dynamics shift from supporting growth to generating contraction. The formation process shows how that shift occurs, gradually in most cases, through the accumulation of stresses and the reversal of behaviors, through the interaction of credit, leverage, expectations, and interconnection. Each recession's formation differs in details, but the broad pattern remains consistent. Imbalances build during expansion. Confidence eventually shifts. Credit contracts. Activity declines. Recession emerges. This pattern reveals the rhythm of the financial system, the cycle of expansion and contraction that repeats despite efforts to achieve permanent stability. The rhythm is not regular. Expansions vary in length. Recessions differ in timing and severity, but the cycle persists. Understanding the formation of recession means understanding this cyclical nature, seeing it not as failure but as feature, recognizing it as revealing something fundamental about how the financial system operates. Once a recession is underway, the financial system functions differently than during normal times. The changes are pervasive, touching every aspect of economic activity. The most immediate change involves credit availability. Banks become more selective about lending. They scrutinize borrowers more carefully. They require more documentation and larger down payments. They charge higher interest rates to reflect increased risk. This caution is understandable from the bank's perspective. During recession, default rates rise. Businesses fail more frequently. Unemployment increases, making personal loan repayment less certain. Banks protect themselves by becoming more conservative. But this individual prudence creates collective problems. Reduced lending means less credit available for businesses to operate and invest. Less credit for consumers to make major purchases. The contraction in credit amplifies the contraction in economic activity. This credit dynamic reveals a key feature of the financial system. It is not designed to be counter-cyclical. It does not automatically stabilize the economy. Instead, it follows and amplifies prevailing trends. During recession, interest rates often fall as central banks attempt to stimulate activity. Lower rates are meant to encourage borrowing and spending. But if banks are unwilling to lend or borrowers are reluctant to borrow, lower rates have limited effect. This reveals the limits of monetary policy during recessions. Rates can be lowered, but credit transmission can still break down. The financial system can become resistant to stimulus when fear and caution dominate. Asset markets also function differently during recession. Stock prices typically decline as earnings fall and expectations worsen. Real estate values soften as demand weakens and financing becomes scarce. Bond prices may rise as investors seek safety, but corporate bonds become riskier and their prices fall. These price movements create wealth effects. Households see the value of their savings and homes decline. This perceived loss of wealth encourages further reductions in spending. The wealth effect that supported consumption during expansion now works in reverse. The functioning of asset markets during recession reveals their connection to the broader economy. Markets are not separate from economic conditions. They reflect and amplify those conditions. They translate recession into losses that affect behavior and perpetuate contraction. Labor markets experience distinct changes during recession. Businesses reduce hiring. They lay off workers to cut costs. Job openings decline. Unemployment rises. Workers who lose jobs face difficulty finding new ones. Competition for available positions intensifies. Some workers accept positions paying less than their previous jobs. Some exit the labor force entirely, discouraged by poor prospects. Wage growth slows or turns negative during recession. With less bargaining power, workers cannot demand increases. With excess labor available, employers have little incentive to raise pay. This wage stagnation reduces household income and spending capacity. The labor market dynamics reveal how recessions distribute hardship unevenly. Some workers remain employed throughout. Some experience temporary unemployment. Some face long-term joblessness or permanent career disruption. The financial system offers limited protection against these individual hardships. Unemployment insurance provides temporary income replacement in some cases, but it is partial and limited in duration. For many, recession means real and lasting economic damage. Business operations adjust to recessionary conditions in systematic ways. Companies cut costs to maintain profitability as revenue declines. They reduce inventory to preserve cash. They postpone investments and expansion plans. They focus on survival rather than growth. These defensive measures make sense for individual businesses, but collectively, they deepen the recession. Reduced spending by businesses means less income for their suppliers and employees. Less investment means less demand for capital goods and construction. The rational response of individual firms worsens the aggregate situation. This paradox of individual rationality producing collective problems is revealed clearly during recession. What makes sense for each actor separately creates difficulties for all actors together. The financial system lacks mechanisms to overcome this coordination failure. Government finances also function differently during recession. Tax revenues decline as incomes and spending fall. Spending on unemployment benefits and social programs increases. Budget deficits widen even without policy changes. Governments may respond by cutting spending to control deficits. But spending cuts further reduce demand in an already contracting economy. Alternatively, governments may increase spending deliberately to offset private sector contraction. This creates larger deficits, but may help limit the recession's depth. The functioning of fiscal policy during recession reveals tensions in the financial system. The logic of household budgets suggests spending should match income. But the logic of macroeconomics suggests government spending should increase when private spending falls. These conflicting logics create political and practical challenges. International trade patterns shift during recession. As domestic demand falls, imports typically decline. This helps domestic producers but hurts foreign exporters. If multiple countries experience recession simultaneously, global trade contracts significantly. Exchange rates adjust to reflect relative economic conditions. Currencies of countries in severe recession may weaken. This makes their exports cheaper and imports more expensive. These adjustments help rebalance trade, but also transmit recessionary pressures between countries. The international dimension reveals how interconnected modern financial systems are. Recessions rarely remain contained within national borders. They spread through trade, finance, and confidence channels. Global financial integration means national recessions can become international. Financial institutions themselves face stress during recession. Banks experience rising loan defaults. Investment firms see asset values decline. Insurance companies face claims while their own portfolios lose value. Some institutions may fail if stress becomes severe. Their failure can create panic and further loss of confidence. It can trigger withdrawals from other institutions. It can freeze credit markets as counterparties become uncertain about each other's solvency. The functioning of the financial system during recession thus involves multiple risks. The risk of credit contraction. The risk of asset price spiral. The risk of employment collapse. The risk of institutional failure. The risk of international contagion. These risks interact and reinforce each other. Each makes the others worse. The system that seemed stable during expansion reveals itself as vulnerable during contraction. Yet the system continues to function. Banks still accept deposits and make some loans. Markets still operate, even as prices fall. Businesses still produce goods and services, even at reduced levels. Employment declines, but does not disappear entirely. This continued functioning, even under stress, reveals resilience alongside fragility. The system bends but does not break completely. Activity contracts but does not cease. Life becomes harder but continues. The day-to-day operation during recession thus shows the financial system under pressure, operating in ways that amplify contraction rather than resist it, revealing vulnerabilities that are invisible during good times, yet maintaining enough functionality to enable eventual recovery. The duration of this stressed operation varies. Some recessions are brief, lasting months. Others persist for years. The length depends on many factors, including the severity of underlying imbalances, the effectiveness of policy responses, and the restoration of confidence. Throughout the duration, the system functions in this diminished mode. Credit remains tight. Asset prices remain depressed. Unemployment remains elevated. Activity remains below capacity. This protracted period of weak functioning reveals the system's difficulty in self-correcting. Market forces alone do not quickly restore prosperity. The downward momentum, once established, persists until something breaks the cycle. What breaks the cycle varies. Sometimes policy interventions restore confidence and stimulate demand. Sometimes the passage of time allows debt to be worked down and balance sheets to heal. Sometimes new technologies or opportunities emerge that justify renewed investment. But the recovery typically requires more than simply waiting. It requires active efforts to address the forces perpetuating contraction. It requires measures to restore credit flow, stabilize asset prices, support employment, and rebuild confidence. The need for such active intervention reveals that recessions are not self-correcting in acceptable timeframes. Left entirely to market forces, they might eventually resolve. But the cost in lost output, unemployment, and hardship would be severe. The damage to the financial system itself might be irreparable. So policy interventions become necessary, not because markets cannot eventually adjust, but because the adjustment process, if left entirely alone, would be too costly and too slow. This necessity reveals a fundamental aspect of the financial system. It requires management during crises. It requires institutions capable of providing support and direction when private actors cannot coordinate effective responses themselves. The day-to-day functioning during recession thus demonstrates both the system's limitations and its needs. Its limitations in self-stabilizing, its need for external support during stress, its dependence on confidence and coordination that can break down under pressure. These demonstrations provide insight into the system's normal operation. What works smoothly during expansion requires confidence and coordination. What seems automatic during growth requires conscious effort during contraction. What appears stable during calm reveals itself as contingent during storm. The functioning during recession is thus highly revealing. It strips away the appearance of automatic stability. It shows how much depends on intangible factors like confidence and expectations. It demonstrates how individual rationality can produce collective dysfunction. These insights are available only during recession. Normal times hide these dynamics beneath smooth operation. Only stress reveals the underlying mechanics and their vulnerabilities. The revelation is unwelcome but valuable. Unwelcome because of the hardship involved. Valuable because of the understanding provided. Understanding of how the financial system truly works beneath its calm surface. Recessions reveal how deeply the financial system connects to other aspects of social and economic life. The connections extend far beyond banks and markets. The household sector experiences recession through multiple channels. Through unemployment and reduced income. Through declining asset values. Through reduced access to credit. Through increased economic uncertainty. These pressures affect household behavior in fundamental ways. Consumption declines as income falls and uncertainty rises. Saving increases as households prepare for potential hardship. Major purchases are postponed. Debt repayment becomes a priority over new spending. This shift in household behavior feeds back to the financial system. Reduced consumption means reduced business revenue. Increased saving means banks receive deposits but face reduced demand for loans. Debt repayment reduces household leverage but also reduces spending in the present. The interaction reveals how household decisions and financial system operations are intertwined. What happens in the financial system affects households directly. How households respond affects the financial system's functioning. Neither can be understood in isolation. The corporate sector's interaction with the financial system intensifies during recession. Companies that were profitable during expansion may struggle during contraction. Revenue declines while fixed costs remain. Cash flow becomes strained. Survival becomes the priority. Many companies carry debt from investments made during better times. This debt must be serviced even as revenue falls. Interest payments remain fixed while income becomes variable. The mismatch creates pressure that can lead to defaults or bankruptcy. When companies fail, the effects ripple through the financial system. Banks lose money on defaulted loans. Suppliers lose customers. Employees lose jobs. The failure of one firm can trigger difficulties for others. This cascading effect reveals the network structure of the economy. Companies are not independent entities. They are nodes in networks of suppliers, customers, creditors, and employees. Stress at one node transmits through connections to other nodes. The financial system both creates these networks and is affected by them. Credit creates relationships between lenders and borrowers. Trade creates relationships between buyers and sellers. Employment creates relationships between firms and workers. When recession stresses these relationships, the effects spread throughout the system. Government interactions with the financial system become particularly visible during recession. Tax revenues decline automatically as incomes and spending fall. This creates fiscal stress for governments at all levels. Governments must choose how to respond. They can cut spending to match reduced revenue. They can maintain spending and accept larger deficits. They can increase spending deliberately to support the economy. Each choice has different implications for the financial system. Spending cuts reduce government demand for goods and services. This further reduces economic activity. It can deepen recession even as it reduces deficits. Maintaining or increasing spending supports demand, but it requires borrowing, which increases government debt. This borrowing must be financed through financial markets. During recession, markets may demand higher interest rates to lend to governments perceived as risky. The interaction reveals tensions between fiscal responsibility and economic management. What seems prudent from a budgetary perspective may be counterproductive from an economic perspective. The financial system provides no automatic resolution to this tension. Central banks also interact more actively with the financial system during recession. They typically lower interest rates to stimulate borrowing and spending. They may purchase assets to inject money into the system. They may provide emergency lending to troubled financial institutions. These interventions reveal the central bank's role as system manager, not merely as interest rate setter, but as emergency responder when the system faces severe stress. The interventions are controversial. They involve using public resources to support private institutions. They create moral hazard by protecting entities from the full consequences of their decisions. They raise questions about fairness and appropriate boundaries for government involvement. But without such interventions, recessions can deepen catastrophically. Financial panics can destroy otherwise viable institutions. Credit markets can freeze completely. The damage can exceed what is necessary or beneficial for economic adjustment. The interaction thus reveals a dilemma. The financial system requires management during crises to prevent excessive damage. But management creates its own problems and risks. There is no perfect solution, only choices between imperfect alternatives. International interactions become strained during recession. Countries experiencing recession import less from trading partners. This transmits weakness across borders. It can synchronize recessions globally. Financial flows between countries also shift. Investors may withdraw money from countries perceived as risky. This capital flight can worsen recessions in affected countries. It can trigger currency crises that compound economic difficulties. The interaction reveals how financial integration creates both opportunities and vulnerabilities. Integration allows capital to flow to productive uses globally. But it also allows crises to spread rapidly. Domestic problems can become international through financial channels. Social systems interact with the financial system through recession's effects on individuals and communities. Unemployment creates stress beyond lost income. It affects mental health, family stability, and social cohesion. Communities dependent on struggling industries face collective hardship. These social effects feed back to the financial system. Stressed households default on obligations more frequently. Troubled communities see property values decline more severely. The erosion of social capital makes economic recovery more difficult. The interaction reveals that the financial system is embedded in society. It is not a separate technical mechanism. It is woven into the fabric of social life. Its functioning affects and is affected by social conditions. Educational systems face pressures during recession. Reduced tax revenues constrain school budgets. Families may struggle to afford education expenses. Yet education becomes more important as workers need to adapt to changing opportunities. The financial system's stress thus creates tensions in educational systems between resource constraints and increased need, between immediate budget pressures and long-term human capital development. Healthcare systems also interact with recession through multiple channels. Job losses often mean loss of health insurance. Stress contributes to health problems. Budget pressures may reduce access to care. Yet health becomes more precarious when resources are limited. These interactions reveal the financial system's central role in enabling access to essential services. When the financial system contracts, access to healthcare, education, and other services becomes more difficult. The recession's effects extend beyond economic metrics to fundamental aspects of well-being. Political systems face pressures as recession creates discontent. Unemployment and hardship generate demands for action. Governments face criticism for economic conditions regardless of their actual responsibility. Political instability can increase during prolonged recessions. This interaction reveals how economic stress can affect political stability. The financial system's functioning thus has political implications. Economic crisis can create political crisis. Political crisis can then worsen economic conditions. The interactions between the financial system and other systems are thus bidirectional and reinforcing. Financial stress affects households, businesses, governments, and social institutions. Their responses feed back to affect the financial system's functioning. The loops can amplify problems or, with appropriate intervention, facilitate recovery. Recession reveals these interactions by stressing them. During normal times, the interactions operate smoothly. Financial flows support household consumption, business investment, government services, and social programs. The system's functioning enables broader social and economic life. During recession, the interactions become strained. Financial constraints limit what households can consume, businesses can invest, governments can provide, and social institutions can maintain. The revelation is of dependency, of how much modern life depends on the financial system's normal functioning. This dependency creates both efficiency and vulnerability. Efficiency because specialization and financial intermediation enable productivity. Vulnerability because disruption in one system cascades through others. The interactions also reveal possibilities for intervention. Because systems are connected, action in one area can affect others. Government spending can support household income and business demand. Central bank actions can stabilize financial markets and improve credit availability. International coordination can prevent beggar-thy-neighbor policies that worsen global recession. But intervention is complicated by the interactions themselves. Actions in one system affect others in complex ways. Unintended consequences are common. What helps in one dimension may harm in another. The complexity of interactions means there are no simple solutions to recession. No single lever that can restore prosperity. Only combinations of measures across multiple systems, coordinated in time and compatible in effect, can address the comprehensive challenge recession presents. This complexity is revealed most clearly during recession. Normal times hide it beneath smooth operation. Crisis exposes it through breakdown and the need for comprehensive response. Understanding these interactions provides insight into both recession and normal times. It shows how the financial system connects to everything else, how its functioning enables modern life, how its disruption affects all aspects of society. The revelation is of interconnection, of systems within systems. of feedback loops that can amplify or dampen disturbances, of complexity that resists simple management but requires sophisticated coordination. This understanding is available only when stress makes the connections visible, when recession reveals what prosperity concealed, when the system's functioning must be questioned rather than taken for granted. Recessions place the financial system under stress that reveals its points of failure and its sources of stability. The stress is comprehensive, affecting all components simultaneously. Banking systems face particular stress during recession. Loan defaults increase as borrowers struggle with reduced income. Asset values decline, affecting collateral supporting loans. Depositors may withdraw funds out of caution or need. These pressures threaten bank solvency and liquidity. Solvency is threatened when loan losses exceed capital buffer. Liquidity is threatened when withdrawals exceed available cash and liquid assets. If stress becomes severe, banks can fail. Failure can happen suddenly when confidence evaporates. Depositors rush to withdraw, creating bank runs. The bank cannot meet all demands simultaneously and must close. Bank failures reveal vulnerabilities in the financial system. They show how dependent the system is on confidence, how quickly stability can turn to panic, how contagion can spread from one institution to others as depositors fear for the safety of their funds everywhere. Modern systems have safeguards against such failures. Deposit insurance protects small depositors. This insurance prevents runs by assuring people their deposits are safe even if the bank fails. The assurance itself prevents the runs that would cause failure. Capital requirements force banks to maintain buffers against losses. These buffers absorb losses before depositors are affected. Regulatory oversight monitors banks to identify problems early. Central banks serve as lenders of last resort. They can provide emergency funds to solvent banks facing temporary liquidity problems. This prevents viable institutions from failing due to panic rather than fundamental weakness. These safeguards have made banking more stable. Outright bank failures have become less common. When they occur, they are managed to limit contagion. The system has learned from past crises and developed mechanisms to prevent repetition of the worst outcomes. But safeguards themselves reveal aspects of the financial system. They reveal its inherent fragility without intervention. They reveal the need for institutional support during crisis. They reveal that stability is not automatic but must be actively maintained. Financial markets face their own forms of stress during recession. Asset prices can decline sharply as investors reassess values and risks. Liquidity can evaporate as buyers withdraw from markets. Trading can become disorderly as panic selling occurs. In severe cases, markets can malfunction. Prices may not reflect fundamental values, but rather the urgency of forced selling. Markets that normally provide price discovery and liquidity fail to perform these functions. The breakdown reveals how dependent market functioning is on normal conditions. Circuit breakers and trading halts exist to prevent the worst market panics. These mechanisms pause trading when price movements become extreme. The pause allows time for information to be absorbed and emotion to subside. It prevents the positive feedback loop, where falling prices trigger more selling, which triggers further price declines. These interventions reveal that markets need management during stress. That pure market forces during panic can produce destructive outcomes. That stability requires mechanisms to interrupt cascading failures. Corporate failures increase during recession. Companies with weak business models or excessive debt cannot survive reduced demand and tight credit. Bankruptcy allows orderly failure, with assets redistributed to more viable uses. But failure still imposes costs on workers, creditors, and communities. The pattern of failure reveals which businesses were viable only under favorable conditions, which were sustained by cheap credit rather than genuine profitability, which depended on unsustainable growth assumptions. Recession thus performs a sorting function, separating sustainable from unsustainable enterprises, reallocating resources from failing to surviving businesses. This reallocation is often described as healthy adjustment. But the adjustment process is painful. Job losses are real even if ultimately resources will be better deployed. Communities suffer even if the aggregate economy will eventually benefit. The costs are immediate while benefits are delayed and uncertain. This tension reveals a fundamental aspect of the financial system. It is efficient in allocating resources over time, but it can be harsh in how it imposes adjustment costs in the present. Efficiency and kindness do not always align. Sovereign stress occurs when governments face their own financial difficulties during recession. Declining revenues and rising spending create budget deficits. These deficits must be financed through borrowing. But markets may demand high interest rates or refuse to lend if they doubt repayment ability. Sovereign debt crises reveal how governments themselves can be subject to financial system pressure, how their ability to respond to recession can be constrained by market confidence, how loss of confidence can create self-fulfilling crises where borrowing costs rise to levels that make default more likely. International institutions like the International Monetary Fund exist to provide emergency support during such crises. This support comes with conditions requiring policy changes. The conditions often involve austerity measures that deepen recession in the short term. These interventions reveal tensions in the global financial system between national sovereignty and international financial stability, between short-term pain and long-term sustainability, between creditor demands and debtor capacities. Despite all these stresses and failures, the financial system displays remarkable resilience. Most recessions end without complete collapse. The system bends but does not break entirely. Recovery eventually occurs. This resilience comes from multiple sources, from the diversity of actors and institutions. No single failure can bring down the entire system. Problems in one area can be contained while others continue functioning. Resilience comes from flexibility. Prices adjust to reflect new conditions. Resources gradually shift from declining to growing sectors. Behaviors adapt to changed circumstances. Resilience comes from learning and adaptation. Each crisis leads to new safeguards and better practices. Institutions develop experience in crisis management. Policies evolve to address newly recognized vulnerabilities. Resilience comes from policy intervention. Central banks provide liquidity during panics. Governments support demand through fiscal measures. Regulators manage failing institutions to limit systemic damage. International coordination addresses global dimensions of crisis. The combination of these factors has allowed the financial system to survive repeated recessions. To learn from each episode. To become more robust over time, even as new vulnerabilities emerge. But resilience is not the same as invulnerability. The system can still face severe stress. Particular recessions can cause lasting damage. Recovery is not guaranteed to be quick or complete. Recession reveals both the resilience and its limits. Shows what the system can withstand and what overwhelms it. Demonstrates the importance of active management while acknowledging the limits of control. The balance between fragility and resilience is perhaps the deepest revelation of recessionary stress. The system is neither as stable as it appears during good times nor as vulnerable as it seems during crisis. It is both strong and weak, depending on circumstances and responses. Understanding this balance means accepting that the financial system will face periodic stress, that failures will occur, that intervention will be necessary, that perfect stability is not achievable. It also means recognizing that the system can survive and recover from stress, that mechanisms exist to prevent the worst outcomes. That resilience is built through experience and institutional development. That adaptation and learning continue across cycles. The stress of recession thus serves a revealing function. It tests the system thoroughly. It exposes weaknesses that need addressing. It demonstrates strengths that can be relied upon. It provides information available no other way. This information is painful to acquire, but it is genuine. It is based on actual performance under pressure rather than theoretical capability. It is knowledge earned through experience rather than assumed from design. The financial system that emerges from recession carries this knowledge. It is strengthened in areas where vulnerabilities were addressed. It is aware of weaknesses that persist. It is better prepared for future stress, even as it can never be completely prepared. Stability is thus not a fixed state, but an ongoing achievement. It must be maintained through vigilance and adaptation. It must be defended during crisis through active intervention. It must be rebuilt after each recession through policy adjustment and institutional reform. Recession reveals the work required to maintain stability, the active management needed, the constant attention necessary, the impossibility of pure laissez-faire when the system faces stress. This revelation shapes understanding of the financial system's proper operation. It shows that stability requires governance, that markets need oversight and support, that intervention during crisis is not interference but necessity. Yet intervention creates its own challenges. Moral hazard when institutions are protected from consequences. political difficulty in determining appropriate responses, practical challenges in timing and calibrating interventions. The tension between the need for intervention and its problematic aspects is revealed clearly during recession. There is no perfect answer. Only choices between flawed alternatives. Only judgments about lesser evils. This ambiguity is itself a revelation about the limits of knowledge and control, about the irreducible uncertainty in managing complex systems, about the impossibility of perfection in financial system governance. Accepting these limits is part of mature understanding, recognizing that the financial system will periodically fail in various ways, that responses will be imperfect, that some damage is unavoidable, that stability is relative rather than absolute. Recession teaches these lessons through experience, through stress that reveals failure and resilience in equal measure, through challenges that must be met despite imperfect understanding and limited tools. The teaching is harsh but valuable. It provides knowledge that shapes future management of the system. It creates wisdom that informs policy and practice. It builds institutional capacity through trial and adaptation. The financial system thus evolves through cycles of stress and recovery, each recession revealing new aspects, each crisis spurring new safeguards, each failure informing future efforts to maintain stability. The evolution is not linear progress. New vulnerabilities emerge even as old ones are addressed. Financial innovation creates new risks. Globalization creates new transmission channels. Each generation faces new challenges alongside old ones. But the capacity to respond improves through accumulated experience. Institutions become more sophisticated. Policies become more nuanced. Understanding deepens even as questions persist. Recession is the crucible in which this development occurs, the test that reveals what works and what does not, the teacher that instructs through hardship rather than theory, the force that shapes the system through repeated cycles of stress and adaptation. The exploration of what recessions reveal about the financial system has covered extensive ground. Now there is time to revisit this territory more slowly, to allow the understanding to settle and deepen. Recessions are periods of economic contraction, times when activity declines rather than grows, when the forward momentum of expansion reverses into the backward movement of decline. These periods reveal aspects of the financial system that remain hidden during normal times. They expose the architecture beneath the surface. They demonstrate how the system actually functions under stress. The most fundamental revelation is of cyclicality. The financial system does not produce steady growth. It produces alternating periods of expansion and contraction. This rhythm is not accidental, but inherent to the system's structure and operation. During expansion, certain behaviors become common. Borrowing increases as confidence rises. Leverage builds throughout the economy. Asset prices rise, sometimes beyond sustainable levels. Imbalances accumulate beneath the surface of prosperity. Eventually, something shifts. Confidence wavers. Credit tightens. The self-reinforcing cycle of expansion reverses into a self-reinforcing cycle of contraction. This reversal reveals the financial system's procyclical nature. The mechanisms that amplified growth during expansion amplify decline during recession. The system magnifies whatever direction the economy is moving. Credit availability demonstrates this clearly. Banks lend freely when times are good. They restrict lending when times are bad. This pattern, though rational for individual banks, intensifies economic swings. Asset prices show the same dynamic. Rising prices during expansion create wealth that supports spending. Falling prices during recession destroy wealth and encourage retrenchment. The procyclical movement of prices amplifies economic cycles. The revelation of procyclicality shows that the financial system is not inherently stabilizing. It does not automatically moderate economic fluctuations. It tends instead to amplify them. Recessions also reveal the role of leverage in creating fragility. Debt accumulated during expansions must be serviced during contractions. This creates burden when income falls. It can force further cutbacks in spending. It can lead to defaults that cascade through the system. High leverage means small shocks can have large effects. Entities with little equity cushion cannot absorb losses. They must cut back dramatically when conditions deteriorate. The system becomes brittle when leverage is excessive. This fragility is invisible during good times when income covers debt service comfortably. Only recession reveals the vulnerability. Only stress shows how much apparent prosperity rested on borrowed foundations. Another revelation concerns expectations and confidence. The financial system operates largely on promises about the future. Loans promise repayment. Investments assume future return. The system functions as long as these promises seem credible. When confidence erodes, the system's dependence on psychology becomes apparent. Fear can be as powerful as fact. Expectations can become self-fulfilling. What people believe about the future shapes behavior in ways that create that future. This psychological dimension makes the financial system inherently unstable. Mood and sentiment matter as much as material conditions. Confidence can shift suddenly, triggering rapid changes in behavior and outcomes. Recessions reveal interconnection throughout the system. Banks, businesses, households, governments, and markets are linked through multiple channels. Problems in one area spread to others. Local difficulties can become systemic. The networks that enable efficiency during normal times become transmission mechanisms during crisis. The connections that allow smooth operation amplify disruption. The complexity that creates productivity also creates vulnerability. During recession, credit contracts across the economy. Banks lend less. Businesses borrow less. Consumers rely less on credit for purchases. This contraction starves the economy of the lifeblood it needs for normal functioning. The credit contraction reveals how dependent modern economies are on the continuous flow of credit. How much ordinary activity relies on borrowing to bridge timing gaps? How quickly activity slows when credit becomes scarce? Asset prices decline during recession, affecting wealth and confidence. Lower stock prices reduce the perceived wealth of investors. Lower home prices reduce household net worth. These wealth effects discourage spending and perpetuate contraction. Employment falls as businesses cut costs. Unemployment rises, creating hardship for displaced workers. Wage growth slows or reverses. The labor market shifts decisively in favor of employers over workers. These labor market changes reveal the distribution of recession's impact. Some workers remain secure throughout. Others face prolonged unemployment or career disruption. The burden falls unevenly across the population. Businesses themselves struggle during recession. Revenue declines while many costs remain fixed. Companies must cut expenses to survive. Investment and expansion plans are postponed or canceled. Some firms fail entirely. The pattern of business difficulties reveals which enterprises were viable only under favorable conditions, which depended on cheap credit or unsustainable growth. Recession sorts sustainable from unsustainable business model. Government finances come under stress as tax revenues fall and spending on support programs rises. Budget deficits widen. Governments face difficult choices between supporting the economy and controlling debt. The fiscal pressures reveal tensions between different objectives, between immediate economic needs and long-term fiscal sustainability, between supporting those harmed by recession and limiting government involvement in the economy. International transmission of recession occurs through trade and financial linkages. Weak demand in one country affects exporters in others. Financial stress spreads across borders through global markets. Recessions can synchronize internationally. This global dimension reveals how interconnected modern economies have become, how national economic management must consider international effects, how domestic problems can have external origins and consequences. Throughout recession, the financial system continues operating, but in diminished form. Credit still flows, but more cautiously. Markets still function, but with greater volatility. Institutions still operate, but under stress. This continued functioning reveals resilience alongside fragility. The system can absorb significant shock without complete collapse. Activity contracts but does not cease entirely. Life becomes harder but continues. Yet the system does not quickly self-correct. Market forces alone do not swiftly restore prosperity. The downward momentum, once established, persists without intervention. This resistance to self-correction reveals the need for active management, for policy responses that support the system during stress, for institutions capable of providing liquidity, stabilizing markets, and supporting demand. Central banks provide such support through interest rate cuts and asset purchases, through emergency lending to troubled institutions, through various measures to maintain credit flow and market functioning. These interventions reveal the central bank's crucial role during crisis, not merely as routine policy setter, but as emergency responder and system stabilizer, as lender of last resort when private markets fail. Governments provide support through increased spending and tax relief, through unemployment benefits and social programs, through measures to prevent widespread hardship and maintain social stability. Fiscal interventions reveal government's role in offsetting private sector contraction, in maintaining demand when businesses and households pull back, in providing the spending that keeps the economy from collapsing entirely. But both monetary and fiscal interventions have limitations. They cannot immediately restore prosperity. They cannot eliminate all hardship. They face practical and political constraints. The limitations reveal that while intervention is necessary, it is not sufficient. While it can moderate recession, it cannot prevent all pain. While it can shorten duration, it cannot restore normalcy instantly. Recovery from recession requires time. Time for debt to be worked down. Time for confidence to rebuild. Time for new opportunities to emerge and justify renewed investment. The recovery process reveals that economic activity has momentum. That changing direction requires sustained effort. That patience is necessary alongside active policy. Eventually, recovery does occur. Credit begins flowing more freely. Asset prices stabilize and rise. Employment increases. Confidence returns. The cycle turns upward again. This eventual recovery reveals the financial system's fundamental resilience, its capacity to survive stress and resume functioning, its ability to adapt and rebuild after damage. But each cycle leaves lessons. Each recession exposes vulnerabilities that may be addressed before the next downturn. Each crisis spurs reforms intended to prevent repetition. Safeguards are strengthened over time. Deposit insurance prevents bank runs. Capital requirements create buffers against losses. Regulatory oversight monitors risks. Emergency mechanisms stand ready for activation during crisis. These safeguards reveal learning from past episodes, accumulated wisdom about managing financial system stress, institutional capacity built through repeated experience with crisis and recovery. Yet new vulnerabilities emerge even as old ones are addressed. Financial innovation creates new risks. Globalization creates new transmission channels. Each generation faces novel challenges alongside familiar ones. The ongoing evolution reveals that financial system management is never complete. That stability must be continuously maintained through vigilance and adaptation. That each success creates new conditions requiring new responses. What recessions reveal, ultimately, is the true nature of the financial system. Not as a stable mechanism, but as a dynamic, complex, adaptive system. One that cycles between growth and contraction. One that amplifies whatever forces are in motion. One that depends on psychology as much as material conditions. The system is fragile in certain ways, vulnerable to loss of confidence, susceptible to cascading failures, prone to procyclical behavior that intensifies swings. Yet it is also resilient, capable of surviving stress, able to adapt and recover, supported by institutions and policies that prevent complete collapse. This dual nature of fragility and resilience is the deepest revelation. The system is neither as stable as it appears during prosperity, nor as vulnerable as it seems during crisis. It is both, depending on conditions and responses. Understanding this dual nature means accepting that recessions will occur, that the financial system will periodically come under stress, that intervention will be necessary, that some hardship is unavoidable. It also means recognizing capacity for recovery, for learning and adaptation, for incremental improvement in managing cycles, for resilience built through experience and institutional development. The understanding comes at a cost, the cost of the recessions themselves, the hardship they impose, the output lost and lives disrupted. But the understanding is genuine, based on evidence rather than theory, grounded in experience rather than assumption, revealing truths about how the system actually works rather than how it might ideally operate. These truths inform how the financial system is managed, how policies are designed, how safeguards are constructed, how interventions are calibrated. They shape expectations about what is possible, about what can be achieved and what cannot, about where improvement is feasible and where limits must be accepted. The revelations of recession thus serve a purpose beyond the immediate episode. They provide knowledge that shapes the system's future evolution. They create understanding that informs ongoing management. This knowledge accumulates across cycles, each recession adding to institutional memory, each crisis teaching lessons that influence future responses. The financial system that emerges from this process is more sophisticated than its predecessor, better able to manage stress, more resilient in the face of shock, yet still subject to cycles, still vulnerable to stress, still requiring active management. The revelations continue with each recession, each exposing new aspects or confirming old lessons, each demonstrating anew the system's fundamental nature. This nature includes cyclicality that cannot be eliminated, fragility that must be managed, resilience that can be strengthened, complexity that resists simple control. Understanding this nature is the value recession provides. Through hardship, it reveals truth. Through stress, it exposes architecture. Through failure, it demonstrates what requires support. Through recovery, it shows what works. The understanding is unwelcome but valuable, costly but genuine, difficult but illuminating. It shows the financial system as it truly is, complex and fragile and resilient, cyclical and interconnected and psychological, requiring management and capable of survival. This is what recessions reveal. This is the understanding they provide. Through their unwelcome occurrence, through their costly duration, through their eventual resolution. The revelation is complete. The system exposed. The truth visible. Understanding available. To those who observe carefully. To those who reflect deeply. To those who learn from experience. The financial system continues its cycle. Expansion and contraction. Growth and recession. Prosperity and stress. Each phase revealing different aspects. Each transition teaching different lessons. Each cycle deepening understanding. The understanding now rests. Quietly. Gently. Like the system itself between cycles. Waiting for the next revelation. The next test. The next demonstration of what lies beneath.